In early 2026, the United States and allied forces launched Operation Epic Fury, a high-intensity, capital-intensive military campaign against the Islamic Republic of Iran. Historically, when a superpower enters a major geopolitical conflict, global capital panics. Investors rush into the safety and liquidity of U.S. government bonds, a flight to quality that traditionally drives borrowing costs down. This chart shows the U.S. 10-year Treasury yield in the days following the initial strikes. Instead of dropping, yields surged past 4.28%. This upward yield trajectory caught institutional investors off guard, defying the traditional expectation of cheap wartime financing. Operation Epic Fury acts as a massive, unbudgeted accelerant applied to a U.S. fiscal baseline that is already structurally unsustainable. Financing a multi-billion-dollar military campaign while borrowing costs are actively rising forces the United States into an inescapable mathematical trap, a cycle of borrowing merely to service the escalating interest on past debt. To measure the true fiscal danger of this conflict, we have to examine the Congressional Budget Office's baseline projections from February 2026, established right before the hostilities escalated. This table highlights the severe imbalances already baked into current law. The structural deficit was projected at $1.9 trillion, equating to 5.8% of GDP. That is an abnormally elevated figure for a period without a pandemic or a severe domestic recession. Federal debt held by the public had already crossed 101% of GDP and is pacing to reach 120% by 2036, exceeding the previous record set during the industrial mobilization of World War II. Most concerning is the primary deficit, anchored at 2.6% of GDP. This metric calculates the shortfall between government revenues and expenditures while entirely excluding net interest costs. This proves the government's basic operating costs far exceed its income before a single dollar of existing debt is serviced. For decades, the U.S. managed massive debt loads because interest rates remained near zero. That era of costless borrowing is over, and the normalization of higher yield environments has radically altered the budget. Compounding debt paired with these elevated yields pushes net interest payments past $1 trillion for the first time in history. In 2024, the United States crossed an ominous milestone. The annual cost of servicing the national debt now officially exceeds total U.S. defense spending. A baseline where debt service crowds out discretionary spending means the U.S. possesses zero fiscal elasticity. There is simply no buffer left to absorb the shock of a massive geopolitical conflict. The financial anatomy of Operation Epic Fury is defined by an extraordinary velocity of capital expenditure. Unlike previous ground-centric counterinsurgencies, this is a conflict of high-technology aerospace and naval operations. Over its 20-year duration, the Afghanistan war cost an average of roughly $315 million per day. The primary phase of the Iraq War averaged around $652 million daily. This chart compares the daily cost of those historic conflicts with the opening week of the 2026 Iran campaign. The U.S. military operated at an estimated average daily run rate approaching $1.88 billion. In the first 100 hours of the conflict alone, the military burned through an estimated $3.7 billion. These numbers are driven by an asymmetric cost curve. Modern warfare requires the rapid depletion of expensive, highly complex assets to counter relatively cheap adversarial weapons. To neutralize low-cost adversarial drone swarms, the U.S. consumed multi-million-dollar interceptor missiles at an alarming rate. Because the vast majority of this intensive spending was entirely unbudgeted, it drained defense appropriations instantly. Merely maintaining forward-deployed naval and aerospace assets carries a baseline operating cost of roughly $59 million per day. That includes operating major military systems like aircraft carrier strike groups and B-2 stealth bombers. Because the U.S. government maintains no peacetime fiscal surpluses, every single dollar of this extraordinary daily burn rate must be financed through immediate deficit expansion. The Pentagon's rapid depletion of these unbudgeted assets bypasses normal appropriations. It translates instantly into an overwhelming wave of new Treasury borrowing. The shock of this unbudgeted debt issuance does not happen in a vacuum. It must be absorbed by the global bond market. Investors immediately identified two risks. The first is a supply shock. The conflict geographically centers on the Strait of Hormuz, a critical maritime choke point for the global energy trade. War-induced energy disruptions reliably raise global inflation expectations, measured in the bond market by TIPS break-even rates. TIPS break-evens are a financial metric that measures the market's expected inflation rate over a given period by comparing traditional and inflation-protected Treasury bonds. Anticipating that this inflation will prevent interest rate cuts, investors demand higher yields to compensate for the expected loss of purchasing power. The second risk is pure saturation. The market anticipates the sheer volume of new sovereign debt required to fund a prolonged war. This flowchart maps the dual pressures driving the yield curve up. On one side, the energy shock raises inflation expectations. On the other side, the impending supply of war debt forces investors to demand a higher term premium, extra compensation specifically for the risk of holding long-term bonds in a saturated market. These compounding macroeconomic forces completely override the traditional risk-off capital flows that usually pull yields down during international crises. Despite fears of failed Treasury auctions, where the government fails to sell all the debt it offers, the bid-to-cover ratios remain technically functional. The market is still clearing the debt. But that continued demand is a trap. The market is only clearing the debt because the U.S. Treasury is being forced to accept increasingly punitive yields, like the 4.75% awarded on the 30-year bond. Global investors are pricing in a systemic deterioration of U.S. fiscal capacity, effectively weaponizing the cost of the war against the Treasury. This creates a corrosive feedback loop. Every newly issued bond is priced at these elevated wartime yields, and as the massive existing debt stock matures, it must be refinanced at those exact same higher rates. To measure the long-term cost of this yield shock, we can look at a stylized sensitivity model. This table tracks the annual interest cost impact through 2036. The baseline assumes a 4.5% effective interest rate applied to a public debt stock of roughly $28 trillion. In the immediate near term, a 50 basis point yield shock adds roughly $100 billion in extra annual interest costs. If we shift focus to the plus 100 basis point scenario, by the mid-2030s, the larger debt stock rolling over at higher rates generates an additional $300 to $400 billion in extra interest payments every single year. Cumulatively, over a decade, this single war-driven rate shift adds several $trillion to the deficit purely through debt servicing. That cost is totally independent of the direct combat expenditures for munitions and fuel. This brings us to the academic concept of debt fatigue. Economists like Kenneth Rogoff warn that foreign and domestic creditors will not endlessly absorb this compounding issuance without eventually demanding even steeper premiums. This compounding interest math is the core channel through which the conflict threatens U.S. economic stability. The price of rolling over old debt becomes more destructive than the cost of buying new munitions. The United States now faces an ultimate macroeconomic trap, entering what economist Lawrence Summers describes as the red light region. The real interest rate on sovereign debt, represented by the variable R, has now exceeded the economy's long-term growth rate, G. When R exceeds G, the debt-to-GDP ratio automatically grows explosively. The only way to stop it is if the government enforces punishing austerity to run a massive primary surplus. Macroeconomic theory identifies exactly 5 exit paths capable of halting this specific debt trajectory. This graphic outlines 5 theoretical exits. First, extraordinary growth. We eliminate this immediately. A mature economy cannot outpace this burden. Second, default. We cross this out. Treasuries are global collateral. Default triggers banking collapse. Third, spending cuts. Slashing entitlements during conflict is politically impossible. The fourth path is the inflation tax, where the central bank simply monetizes the debt by printing trillions of dollars. But executing this would destroy the U.S. dollar's credibility as a stable store of value, ultimately ending its status as the global reserve currency. That leaves a final, mathematically viable option identified by economists like N. Gregory Mankiw, implementing massive, broadly shared tax increases, such as a value-added tax. A value-added tax, or VAT, is a consumption tax placed on products whenever value is added at a stage of production and at final sale. Decades of deficit spending have exhausted America's fiscal credibility. Financing the 2026 conflict is the final catalyst, boxing policymakers into an unavoidable collision with severe domestic austerity, extreme taxation, or the intentional debasement of the dollar.